Welcome to The Deep Dive, your shortcut to being well-informed, where we cut through the noise and distill the most vital insights from the latest financial reports.
Today, we're taking a deep dive into OneWater Marine Inc.'s fiscal third quarter 2025 performance, really digging into their recent earnings call and what management had to say.
Precisely. This deep dive is designed to be your essential briefing. We'll look at the numbers, sure, but also management strategy.
Yeah.
And, what it all means for the marine industry and, of course, for you as an investor trying to connect the dots.
So let's jump right in. Headline numbers first. OneWater Marine, well, they delivered what turned out to be a really interesting quarter. A bit mixed financially, maybe, but the market reaction was definitely positive. Total revenue was actually up 1.9% year over year, hit $552.9 million, which importantly beat what analysts were expecting. And maybe even more surprising, same-store sales grew by 2% year over year.
Yeah.
In this environment, that's quite something. It absolutely is. That top-line performance, it's incredibly significant when you loom out a bit. I mean, the wider marine industry, comparable categories saw declines. What was it? Over 15%?
Wow.
So for OneWater to not just, hold steady, but actually grow revenue and same-store sales, it really signals something more than luck. It suggests, strong execution, smart strategy, really bucking the trend.
It definitely paints a picture of resilience there on the revenue side. However, when we look at the bottom line, the story shifts a bit, doesn't it?
Mm-hmm.
GAAP EPS, that's generally accepted accounting principles, earnings per share, came in at 65. That's a drop from 0.99 cents last year. And the non-GAAP adjusted EPS was of 79 cents, which actually missed the consensus estimates by around 0.33 cents.
Right.
We also saw gross margins under pressure. They contracted by 110 basis points, so 1.1 percentage points year over year, landed at 23.3%. And adjusted EBITDA followed that trend, coming in at $32.8 million. That's down from $39.2 million the year before. So, yeah, not all good news.
You're right. Those profitability numbers clearly show the tough environment they're in. But despite that EPS miss and the margin pressure, like you said, the market reaction, quite positive.
Yeah.
The stock ticked up nicely. And that tells us investors were likely prioritizing that top-line beat, that surprise growth. And also the relative outperformance against those really strong industry headwinds. And maybe, crucially, the strategic moves management's making.
Right.
They seem to value that adaptability over the immediate profit dip. It's like the market saying, okay, we see the plan, we see you're gaining share.
That's a great way to put it. So let's peel back the layers then. Let's unpack these numbers and get into what management actually said on the call, starting with the segments. New boat revenue saw a slight decline, 2.1%.
Yeah.
But here's where it gets interesting. You touched on this. While the number of new boats sold was down, the average price for those new boats actually went up.
Yeah.
Now, that's counterintuitive in a softening market, isn't it? What's that telling us?
It's fascinating, right? It's a really key insight, I think. It just clearly signals continued pretty robust strength in the premium end of the market. Even with fewer boats moving, those higher average prices mean the more affluent customer. They're still there. They're resilient.
Still buying.
Yeah. Still investing in those higher value boats. It suggests OneWater is successfully tapping into or maybe focusing on that top tier, which kind of insulates them a bit from the broader pullback. It's smart positioning.
So the luxury buyer is kind of holding things up there.
Okay.
But on the flip side, pre-owned boats, that was a huge bright spot, wasn't it?
Oh, absolutely.
Almost surging, up 17.8% year over year. And that was driven by both higher volume and higher average prices. More than enough to offset that dip in new boat sales. That's flexibility right there.
It really is. And it's a strategic pivot that's clearly working for them. Management pointed to a couple of things driving this. First, better inventory on the new boat side means less waiting time. So paradoxically, it actually encourages trade-ins. People know they can get the new one faster.
Makes sense. Smoother upgrade path.
Exactly. And second, maybe even more important, is this sort of trickle-down effect you get. Those premium buyers trading up to the bigger, newer boats. Well, that creates a really healthy supply for the secondary market. They're slightly older, maybe smaller boats.
Right.
And OneWater is jumping on that, focusing on pre-owned, even opening standalone used boat stores. It's a really important buffer in a cyclical business like this.
Yeah, like the CarMax of boats. Almost.
Yeah.
Okay, so beyond boat sales, what about the other income streams? Services, parts, F&I, how did they look?
Mixed results there. Services and parts revenue actually dipped a bit, 1.7%. Management said that was mostly due to lower production levels from the manufacturers impacting their distribution business.
Okay.
But importantly, the service and part sales at the dealership level held up well. That's good recurring revenue.
And finance and insurance, F&I.
That held flat as a percentage of boat sales. So consistent penetration rates there, which is good for profitability, doesn't require holding physical stock,
Right, right. So these numbers, they don't just happen in a vacuum. They're outcomes of a deliberate strategy. Let's pull back a bit and look at that bigger picture management laid out.
Right.
How are they planning to navigate these choppy waters?
Indeed. They really hammered home their relative outperformance. That 2% revenue and same-store sales growth when the industry's down over 15%, that's not luck.
No.
They put it down to strategic positioning, strong execution, especially in what they called a very competitive and promotional environment. It's not just about surviving the storm, it's about actively taking share.
And speaking of promotions, that pressure on gross margins was a big topic. Management linked it to those heightened industry promotions, but also partly their own moves, right? Exiting certain brands, shifts in the model mix.
Exactly. Part external pressure, part internal strategy.
So despite that, they say they're executing an intentional pricing strategy, trying to drive sales, but preserve margin where they can. Tough balance.
It's a very fine line to walk. And central to that strategy right now is really tight inventory management and this brand rationalization piece. Their reported inventory was down, was it 13.6% year over year, down to $517.1 million. That's significant progress.
Yeah, that's huge.
And they're on track, they say, for 10-15% down by year end. And crucially, this isn't just shrinking, it's tied to getting rid of underperforming brands. Lets them focus resources on the better, more profitable relationships, streamlines things, improves cash flow. It's a necessary cleanup.
So optimizing the portfolio, not just cutting costs.
Yeah.
Management laid out 3 core focus areas then.
That's right. 1, get inventory right, focusing on high-performing brands, finish the rationalization. 2, disciplined cost management in this changing retail world. And 3, use their scale and operational know-how to keep outperforming the industry. It's a pretty clear roadmap.
Seems clear, yeah. And what about the wider economy, macro factors? Do they touch on that?
They did. They mentioned tariff uncertainty caused some confusion and noise during the quarter, potential new tariffs making people hesitant.
Right.
But they said since the quarter ended, that concern seems to have eased off a bit, which is helpful. And importantly, price hikes for manufacturers for the 2026 models, they've been moderate, normal levels, apparently settling well with customers, which is good news. No major sticker shock expected.
That's positive.
They also mentioned July performance was encouraging, especially again from those resilient premium customers. Maybe a hint of improving consumer confidence, perhaps.
Let's hope so. Okay, looking ahead then. Guidance for the full fiscal year 2025. They updated it.
They did, and they actually raised their total revenue outlook, now expecting $1.8 billion to $1.85 billion.
Oh, interesting.
And same-store sales, now expected to be up low single digits for the year. Again, that's huge outperformance versus an industry looking at double-digit declines. Adjusted EBITDA projection is $65 million to $80 million, and adjusted EPS between $0.75 and they were clear. This outlook still factors in ongoing economic uncertainty and that competitive selling environment. So they're being realistic.
It really feels like OneWater's performance here is almost a case study in how to navigate a tough demand situation in specialty retail.
I think that's fair. Their ability to grow the top line and same-store sales when the whole industry is shrinking that much, it really speaks volumes, doesn't it? Market share gains, operational strength. For you, the listener, it really highlights why you need to look past just the headline profit numbers and understand the strategy behind them.
You could definitely see that clear strategic repositioning happening. Slimming inventory, exiting those brands, and leaning really hard into that pre-owned momentum to protect cash flow and keep things turning over. That shift, plus having decent liquidity over $85 million, gives them that crucial flexibility when promotions are so intense everywhere.
It feels like calculated moves designed not just to survive, but actually come out stronger. And the market seeing that, reacting positively despite the EPS miss, it suggests investors get it. They're prioritizing that relative strength, the proactive management. Management talks about commercial innovation, pricing, mix, F&I stability, the brand cleanup. It's all very pragmatic. Protect margins where you can, win share where it matters.
So for you listening, things to watch near term. Definitely the pace of those brand exits. How smooth is that? Also, can that pre-owned growth keep up this pace? Is it sustainable?
Good question.
And maybe normalization in OEM production. That could help their distribution side.
True. And of course, the big external factors, overall retail demand, financing costs, how intense promotions stay, those will continue to, well, steer the boat, you could say.
Couldn't resist, could you? Okay, all right, now for something a bit different. We've picked apart the performance, the strategy. Now, for those of you thinking ahead, let's shift to our segment where we toss around some wild but plausible trade ideas based on all this. And remember, folks, this is purely for discussion, definitely not financial advice, just brainstorming here.
Absolutely not advice. But okay, thinking about OneWater's outperformance, that successful pivot to pre-owned, how about this? A long OneWater, short a basket of marine OEM futures kind of play.
Okay, explain that. Long OneWater, short the manufacturers.
Yeah. The thinking is OneWater's retail model benefits from that churn, the trade-ins. It sort of decouples them a bit from the pure manufacturing cycle.
Right.
Whereas the OEMs, the boat builders themselves, they're much more exposed to lower production, maybe pricing pressure.
I see. So it's a bet on retail execution and that flexible inventory model winning out over the upstream supply issues, playing the relative strength, bold.
It's an idea. Or, okay, different angle, maybe less directional. Consider a yield-enhanced call spread on one after the summer selling season.
Whoa, okay, break that down. Yield-enhanced call spread.
Basically, you buy a call option at one price and sell another call option at a higher price, same expiration date. If that encouraging July performance hints at a strong summer sell-through and inventory levels are lower, providing a bit of a price floor, well, a call spread betting on just a modest price bump into Q4 could capture some upside if consumer confidence holds up, if the brand cleanup pays off.
And the yield-enhanced part comes from selling that higher call option, right? The premium you collect helps pay for the one you bought.
Exactly. Makes it more capital efficient.
Yeah.
You don't need a massive stock rally, just some positive momentum. It defines your risk and potential reward.
Interesting angles. Okay, let's recap this deep dive then. OneWater Marine. Solid top-line beat, really strong relative performance against a very tough industry backdrop, driven largely by smart inventory moves, getting rid of some brands, and that impressive deliberate growth in pre-owned.
Yeah, while margins definitely felt the heat from promotions and those strategic shifts, the company's proactive stance and those positive signs in July, it gives a cautiously constructive outlook. Their ability to adapt and execute in this market really does stand out. It makes you wonder, doesn't it? Is this focus on the premium end plus a strong used market, is that a potential blueprint for other luxury or discretionary retail sectors facing similar headwinds? Are we seeing a glimpse of the future of luxury retail?
Interesting thought to leave folks with. As always, this discussion was for informational purposes only. It should definitely not be taken as financial advice. Please do your own due diligence. We appreciate you tuning into the deep dive. Let us know your thoughts, questions on social media. We genuinely love hearing from you.